So my challenge this afternoon is going after lunch, following up an M&A discussion, and trying to make debt exciting. I'm encouraged, though, by the fact that it seemed like most of the questions were focused on debt. And actually, and this is very atypical, typically M&A is the exciting part for bankers. But in this environment, actually, and I'd argue for the past 2 to 3 years, certainly, the debt environment is actually where the action's been. Because, John, as per your question, the M&A market is stagnated. The debt market is arguably as stronger than it's ever been. The only comparable period would be 2006, 2007. So I think I'm up for it, and it seems like capital's very much on people's minds, whether it's just to grow your business, take care of your operations, or to do M&A activity. So what I'm aiming to do is to talk about the overall environment for debt, give some just background, the different types of debt, and I'll also tie in a little bit of equity because I'm obviously acutely aware that equity is a form of capital, but an IPO discussion, which, by the way, is highly relevant for your sector. As you know, Stock Building Supply went public earlier this year. Also, HD Supply did a $1 billion IPO earlier this year. I think there'll be more to come. That's also relevant. But the equity side is a different, separate half-hour conversation. So with that, I'm going to, a little bit by way of background, I've actually done in investment banking over the years. I've done a pretty large amount of work specifically in LBM, particularly in lumber distribution. A lot of work on M&A and financing side with Builders First Source. I mentioned Stock Building Supply and also Lenogo, which of course has become ProBuild. A little outside of lumber, just some names that should be familiar to you. I mentioned HD Supply, but also ABC Supply, Roofing Supply Group, SRS, and so forth. So hopefully a lot of these names are familiar to you. I'm going to go into more details on some of these deals. But my one, and I don't want to scare you by showing you a line chart and an interest rate chart and think you're going to have 20 pages of these. I promise this is the last interest rate chart, and it's slightly duplicative with what Ben said, but I do want to plant the seed for the theme that you're going to hear from me today, that this is an extraordinary period for debt financing. It really is. It's unique in terms of how strong it is historically. And what I've done is, and Ben touched on this theme earlier, I've just shown on the top part of the page, 10-year Treasury, which is the risk-free rate for the 1990s and then for the 2000s. In the 1990s, the average rate for the 10-year was 6.7%. The average rate right now for the high-yield bond index, high yield, by the way, is also known as junk debt, speculative grade debt. I think most of you are familiar with high yield being high yield, 10, 12%. The high yield bond index today is at 5.7%. I think they're going to have to contact Webster's and Merriam to change the definition. Medium yield debt is not particularly catchy, but if you go back historically, this 5.7% rate is inside of where the risk-free rate was in the 1990s. And if you come to where we are today, I think you all know that the 10 years moved. It actually got above 3% earlier this year. It went down a little to about 2.8, 2.85, 2.86%. Following the weak jobs report on Friday, where there are thoughts that maybe the tapering will be decelerated. But if you look back historically in terms of a low-rate interest environment, and I know that's not a revelation to anyone here in the room, we know it is, but taking a look at this, it is an incredible time to go and get debt. And I wanted to ask a question, a simple show of hands. How many of you at your companies have raised debt financing over the past couple of years? All right, well, for those of you who can't look around, I think most of the people, most of the companies here, and wisely so. For those of you that haven't, please wait till the end of this presentation to go out and start the process to raise that debt. Just give me that courtesy, about 20 minutes. I don't believe it's a situation where all of a sudden this window is going to close, but at the same time, it is an extraordinary environment, and there are unknowns out there. Who knows? There could be a geopolitical event, something could happen in Europe, something could happen in China, something could happen here in DC. So the general pearl of wisdom here is while these markets are open, that goes for debt and equity, you hit these markets, especially for cyclical companies. And in terms of where I think this is going, there's some questions on where the cycle is going. In terms of interest rates, I don't think they're going to skyrocket. The forward curve is on the bottom. The forward curve calls for the 10-year rate to go up about 50 basis points from where we are right now, 3.5%. That's still, by historical norms, incredibly favorable. But it's more the other risks of other things happening that are out there, and why not take advantage of this while it can? So from here, I'm going to go into the different types of debt financing. I'll start with it's not a line chart. It's a different visual for you, and hopefully it's visible throughout the room, but just to go through the basic types of debt. So going from top to bottom, the first lien secured debt. This is essentially your bank debt and term loans. This is debt, and especially at the very top, that banks expect to get all of their money back. It's fully collateralized. It could be over-collateralized. If you go down to equity, that's the most expensive form of financing, as you all know. For owner-managers in the room, it's a very simple thought process. Would I rather go out and raise debt and call it 5-6% and keep my full equity ownership and participation in the company going forward? That shouldn't be a difficult decision for you. You hold on to the equity. That's more dear. That's more expensive. It's also, from the person providing that capital, it's also the riskiest because it's not collateralized. It's not secured. There's no promise of dividends. So if you go from the top, and I'll use more common terms for this, but you basically have a revolving credit facility down to term loans, which could be first lien, second lien, then bonds, which could be secured, although that's unusual. The more typical bonds are unsecured, then subordinated, then mezzanine debt. I imagine some of you in the room are familiar with mezzanine debt or preferred stock, which has debt and equity characteristics, and then common equity. Because the debt at the top of the capital structure is secured or collateralized, it's the cheapest. That's the great news. Down at the bottom on equity, that's the most expensive, but that cheap debt for you as an issuer comes as a cost, as all of you know, is typically there are covenants attached to it. And I'd say, you know, for those of you running a company, the covenants that you most worry about, especially for cyclical companies, are covenants that govern the maximum amount of debt that you can have, your debt to EBITDA, debt to cash flow, and also your interest coverage, which is EBITDA or cash flow to interest expense. So where companies ran into trouble during the downturn, I'm sure this is very familiar to many of you in the room, the companies that had bank debt that had these covenants. And if all of a sudden your EBITDA goes from, I'm making up a number, $20 million of EBITDA to $10 million, or it evaporates, guess what? Your debt to EBITDA ratio, you're in violation. Your coverage ratio, EBITDA to interest expense, you're in violation. This is how a lot of companies, unfortunately, in this sector and more broadly across cyclical companies or cyclical sectors, came to be owned by their lenders or went into Chapter 11. So the good news is, I'll segue into the good news, in this debt environment, there are incredible opportunities to have debt, including at the very senior part of the capital structure, which is the cheapest debt, without covenants. And on that note, I'll go to the next page where I talk about two main types of revolving credit facilities, which is asset-based facility, also known as an ABL, versus a traditional revolver, which is cash flow based. So another quick question. For those of you in the room, how many of you have asset-based lending facilities? How many have cash flow-based facilities with debt to EBITDA covenants? I didn't see any hands on that, no. Well, I commend all of you. The good news is for distribution, and this holds true also for retail, which are working capital intensive industries, the ABL facility is really in the sweet spot. And the good thing about the ABL facility is, coming back to this covenant point, is there's no debt to EBITDA covenant. There's no EBITDA to interest expense covenant. So even if there's trouble lurking around the corner, and I don't believe that, I don't see that for certainly 2 to 3 years, if not longer, you could sleep well at night and focus on running your company. You don't have to worry about being in violation of this. What you have to worry about is keeping your inventory and your accounts receivable at a certain level. And as you could see, the other good news for an asset-based facility is this is just indicative pricing, is it's significantly cheaper than a cash flow revolver. So it's cheaper and there's no covenants. So you may think, what's the catch? Well, the only real catch is that you have monthly reporting requirements where you have to report on your inventory and your accounts receivable. For some companies, this isn't a problem. They're set up for this. For a lot of companies outside distribution and retail, this could be a problem. But in the electronic age, it's a lot easier than it used to be when a lot of this stuff was done with reams of paper. So that's on the revolving credit facility. As we go down the capital structure into the type of debt that's used could be used to fund operations, but more for exciting things like growth and M&A, we come to term loans and high yield bonds. Term loans are also known as bank debt. Not typically. They're senior secured, so highly collateralized. There's a lot of commonality with bank debt. They're prepayable without penalty. As opposed to bank debt, you can't draw from it, repay, and then redraw. They're also priced, I didn't mention this on bank debt, but bank debt's priced at a spread to LIBOR, so it's a floating rate security. That's what term loans are as well. They're longer dated than bank debt. Right now, market for bank debt is about 5 years, which is great because 3-4 years ago when this market was just starting and no one was lending, it was hard enough to get a 3-year facility. Now you could get 5-year credit facilities. Term loans are longer. They'll be 5 to 7 years. Traditionally, they have covenants, but I'll come back to that because that's one of the amazing things about this financing environment is the abundance of term loans without covenants. They're known as covenant-light term loans. And the other good thing about term loans, which is in contrast with bonds, is that they're prepayable without penalty. So you get cash flow, you pay them down. You don't have to have them outstanding. So I feel like I've been picking on bonds a little bit, but it was another record year for bonds. As I said, the high yield bond index is at 5.7%. If you go back historically, this is way inside of where bonds are typically issued. But where bonds generally have been favored by issuers, and I understand from many people in the room, bonds, generally the minimum size bond that you're going to do, the sweet spot of the bond market is 200 million, north of 200 million or more. That's a liquid market for a bond. So I know for many of you it's not relevant, it's just interesting. In contrasting with term loans is one of the attractions, because most of the deals that got done in LBM and in general for cyclical companies coming out of the downturn had an ABL structure, no covenant, and then bonds, because bonds don't have maintenance covenants. They have incurrence covenants, which preclude adding on debt once you get past a certain level. But if you have an ABL bond capital structure, you're basically bulletproof, and you don't have to worry or go to bed at night worrying about violating your debt to EBITDA. Bonds are also longer tenured, so you could punch out an 8 or 10-year bond at an attractive fixed rate and not worry about it for 8 to 10 years. On the flip side, bonds are a little more expensive, and there's a non-call period, which is a protection for investors. Basically, what the non-call period means is, for example, for a 10-year bond, generally investors will insist that for 5 years you can't call it unless there's an onerous may call or payment. Why? Because investors are saying, if I'm buying this security at 6, 7, 8%, I want to at least have a period of time where I know I'm not going to get that, and if interest rates go down, I can't just be refinanced out of that. So those are some key distinctions between term loans and bonds. The other thing is, I mentioned this before, is bonds are typically not secured, so you don't have to use up your security. The sweet spot for bonds is unsecured. So this is the debate that's been going on ad nauseum, and for me, bankers in the room, endless debates on whether you do term loans versus bonds. I've touched on a lot of these points, but there's been a very dramatic change in this debate. Because historically, the debate on term loans versus bonds is, yeah, term loans are cheaper, they're prepayable, but you know what? I've got these maintenance covenants that I have to worry about. And I could just do a bond, not worry about covenants. And by the way, the rates on bonds are pretty good. What's happened over the last couple of years, and I have a chart coming up on this, it's truly extraordinary. It's actually much more prevalent than it was even in 2007, is you can now get term loans without covenants. So it's basically, this is a gift horse. It shouldn't be looked in the mouth too hard. It's the best features, arguably one of the best features of the bonds, the no covenants. You get that in a term loan, and yet the debt's prepayable and it's cheaper. So what's the catch? There really isn't a catch. The catch is that for first lien, senior secured term loans, you really can only, and this only, I shouldn't say only, but they generally max out on how much debt you could put on a company. Call it 4 to 5 times in this environment. And if you're seeing LBOs, leveraged buyouts that are financed at 6 to 7 times, you generally have to put a bond beneath that. There's another structure, a second lien term loan, but that's a limited and smaller market. So there's still room for bonds, but this term loan market, especially this covenant-light term loan market, there's never been anything like it. And I've got the data to prove it in 2 slides. But before I get there, I just want to make a point on just how favorable the debt financing environment is. People point to 2007 as the golden age of private equity, and in many cases, by extension, leveraged finance. The bar chart on the left, I know it's difficult to see in the back, but the highest line on the right was 2013 term loan issuance, leverage loan issuance, and it actually is about 70 million above where it was in 2007. And then the rates on the right, the average for double B is 3.5%, and then 4.9% for single B, which is truly extraordinary. I mean, these are leverage loans. These are for companies that have leverage, and you're getting that kind of rates. And then on the covenant light point, which is just an amazing security, issuer-friendly security for all of you, this is difficult to read. I was sitting in the back, so I know this. But basically, the bar chart on the top shows covenant light term loan issuance. And the bar, which is highlighted on the far right, is about 260 million in 2013. In 2007, it was less than 100 million. So 2.5 to 3 times more issuance in this market right now. And why not? It's an extremely attractive instrument for issuers. And you'll see, I'll get to some of the deals that have been done in LBM and distribution. Essentially, all of them, the LBOs, have used this covenant light term loan. The high yield market, my only point here is that I felt like I was giving, less attention to high yield. 2013 was actually a record year for high yield. So what all of you may be thinking is, wow, we just sat through an M&A presentation, M&A is stagnant, and yet there's all this debt issuance. What is this going towards? Well, about 2/3 of all of that debt issuance I just talked about was actually used for refinancing. Which shows that corporate America and executives are thinking correctly about things. Why not take advantage of this incredible debt market? For bankers, frankly, it would be a little more exciting if there was more M&A and other growth projects. But that we'll live with that. We think that will come. And what this chart shows, I think this is interesting, and I haven't seen that much attention given to this in the press, is that this is basically the brown line the brown bar is high yield bonds, the green are, call it leverage loans. This is the amount in billions of debt that's coming due over, call it the next 10 years. And you could see 2014, 2015, 2016, these towers, as we call them, have been pushed down dramatically. So corporate America could actually focus on running their businesses and not kind of, walking in the shadows of these huge debt maturities out there. Once you get to 18, 19, and 20, yes, there are some big towers out there, but that will be dealt with, especially because no one thinks that this debt market's going anywhere soon. And then, talking about how favorable the debt environment is and this disconnect with the M&A market, the truth is, I agree with Ben. I think that one of the things that's holding back this M&A market, especially in cyclical industries, is this disconnect between buyers and sellers. I'm sure many of you today, you may have caught the news on Charter's bid for Time Warner Cable. There's this huge disconnect between what Time Warner Cable wants and what Charter is willing to pay. You can play that out in cyclical industries even more so in terms of the bid-ask spread. But the truth is, in terms of the debt financing market, it really doesn't get much better than this. It got better than this, as you can see. This is the average leverage for LBOs going back to 2000. 2007 was the peak at 6.2 times. We're back up to 5.7 times. Now, some people, when they look at this chart, this could be a little scary. It's the ultimate here we go again moment. But the way I think about it is this 5.7 times, EBITDA? I think if I went around the room here, I think all of you think your EBITDA a year, certainly 2 years out, is going to be higher than it is today. So that 5.7 times is actually a lower number because the EBITDA will be higher. What was scary about 2007 is that was a peak EBITDA. And for many of those companies, the EBITDA went down dramatically or even evaporated in the next year or two. So this doesn't cause me as much concern as the headline numbers might indicate. And in terms of private equity activity, there's a clear trend here. This is quarterly. In terms of LBO volume going back to 2003, you see the huge spike in 2007, the golden age of private equity, then obviously through the downturn, a quieter period. But you could see a clear trend here. The bar chart's volume and the red line is the number of deals. 2013 was the biggest LBO market in terms of volume of deals since 2007. I think that will continue. I think that there's very supportive debt financing environments. There's a lot of money that's looking to go to work, and I think that it's a good time to be buying businesses at this point in the cycle. So this should continue, which is good for all of you. It's good for bankers. And I'll come to equity. This was really focused on debt, but you can't talk about debt without talking about equity. I guess first and foremost, the most direct relevance between the two is when lenders lend money, they have an eye towards what's the equity value. They see that as cushion in terms of getting their money back. So another way of saying that is if you're lending at 5 times EBITDA to a company, but there's 5 times of equity value for a total value of 10 times, it makes you feel a lot better about giving 5 times of debt to EBITDA. And just kind of a feel-good moment for all of us, for the companies in the sector and just for those of us that own stock. I've just shown some indices on the left on stock price performance. The blue line on the bottom on the left is the S&P 500 since January 2012. As you go up, the green are building products manufacturers, the red are distributors, and the home builders are at the top. No surprise that home builders are at the top. That's all new residential construction, and they were off the lowest points. And then on the right, I show just the amount of stock price appreciation since early January 2012. And of note for this audience, who've built this First Source and Stock, who's both performed extremely well. And then one other point on just equity values and multiples, because it is relevant for debt, as I said. The multiples for this sector, kind of another feel-good moment, are the highest that anyone's seen. So if you look at, I know most of Main Street focuses on price to earnings, but in this industry and generally levered industries, enterprise value to EBITDA is kind of the financial professionals look at. Essentially your debt plus your equity over your free cash flow. And right now on an enterprise value, so that's today's debt plus the market cap of a company, this is for public companies, over expected 2014 EBITDA, or cash flow, the average for building products is in double digits, 10 to 11 times. Distributors actually higher than the manufacturers. If you go out to 2015, it's at about 9 times. So obviously there are tremendous growth expectations. I think the people, they're unsure exactly when it's going to happen, but they know it's going to happen and it's going to be meaningful. And the equity markets are willing to look ahead. So let me bring this back to building products and LBM. I talked about high yields. Remember that number I gave before, 5.6%? That's the gray line on top for the broad high yield index, which is inside of where the 10-year rate was in the 1990s. The blue line on the bottom is an index for building materials companies, manufacturers, producers, and distributors. That's actually inside of that by almost a full percentage point at 4.7%. Why? Why do people want to give you money? Why is lending robust? Because people believe in the earnings trajectory and the cash flow generation going forward. So the building materials index is actually inside of the broader high yield index. And if we even go a little more narrow, specifically into some names, building products and distributors, you can see some distributors. This is just alphabetical order. I highlight 2 columns there. The one on the far right is debt to EBITDA. And you can see, these are elevated levels. I think, ideally public companies have lower debt levels. Most of these companies are actually private, but no one there is in the danger zone. Leverage has come down significantly. And the other extraordinary part, just to make sure I'm just beating this dead horse yet again, give the dead horse just another kick, is on the yield to worst, which is essentially what the rate is on these securities. Now, that's a little misleading. That's not to maturity. That's to the call date. So that's not 7, 8, 10-year paper. It's shorter dated, but you can see it's all mid-single digits, which is truly remarkable. And then finally, and then I'll open it up for questions, and hopefully you got all the tough questions out on Ben. Maybe we'll allow for one tough question, although Glenn, I think we're doing well on time. Is just some recent deals in the sector, and I specifically picked distribution deals. So going from left to right, we have private equity firm CD&R buying Roofing Supply Group, the roofing distributor. The second from the left is Berkshire Partners buying SRS, a roofing distributor. And then ABC Supply, the largest roofing distributor in the US, did a significant leverage recap earlier this year where they bought out their minority investor, refinanced the entire capital structure. And then Builders First Source earlier this year did a full refinancing of its capital structure with an ABL and senior secured notes. So just a couple of comments here. What you will see, and this goes back to what I started with, is what all of these capital structures have in common, and these are all large deals, these are all large companies, is no covenants. And you could see for the 3 deals, the 3 LBO, ABC was quasi-LBO, it's the same capital structure. It's this ABL credit facility that I talked about that has no maintenance covenants, then a covenant-like term loan, and then beneath that, and I apologize, I know this is probably hard to read after the 3rd row, but then some sort of junior debt, whether it's high yield, that's what senior notes is, high yield. Those were senior unsecured, BFSs with senior secured, and then for Berkshire, a mezzanine note. And the beauty of all of these capital structures, which are very opportunistic, is that there's no covenants. So you basically, if something happens and no one thinks it's going to happen, but you never know, if something happens to EBITDA, you could sleep well at night and know that you're not going to be in violation. So I think all of these were very prudent capital structures and very opportunistic and good moves. So I'd like to end on that note and just say this really is an extraordinary time to be considering debt financing. And I just note that because there were a couple of questions before on the debt markets.
Wow. Would anybody like to see Ben and Joshua arm wrestle?
Yeah, me neither.
Great stuff, Josh. Thank you. Can you bring it down a little bit to the level of some of us small and medium-sized LBM dealers in the room? What can we expect in terms of the combination of the ABL and term loan structure related to EBITDA?
Yeah, I mean, Paul, the general rule of thumb, as you know, and this is why you're asking the question, is, and this is a disclaimer I could have made at the beginning. A lot of these deals and a lot of these structures are predicated on larger companies, with 50 million of EBITDA or greater. And I appreciate that. Many of the companies in the room aren't of that size, but I think the general theme, Paul, applies to all. It's just night and day in terms of being a more constructive environment. You probably have seen that, as you've been growing your business. So I think it does filter all the way down. But yeah, no, definitely true that the larger you are, the more liquid and the more options you have available, and frankly, the cheaper the debt should be.
Changing quickly, what are your guys' quick thoughts on the S&P 500 this year? And Ben? Yeah.
I mean, by the way, that's a disclaimer. I'm not qualified to comment on that, but I'll try anyway. As you can see from my sentiment here, I'm generally bullish. I actually think you've seen that there's been a little bit of pushback in Q1 as earnings have come back. I just think there's been an extraordinary run-up, and any disappointment will probably be punished. But I think it's generally, barring unforeseeable events, I think there is momentum. I don't think it'll be a rocket ship, but I think it's generally a healthier environment. So I can tell you that personally in my personal portfolio, I'm overweight stocks.
Thank you.
All right, thanks a lot.